Seriously, you're in a mid-level quarterly review when your Apple Watch buzzes with a leaked headline about the next crypto crash. Suddenly, the revenue projections for Q3 don't seem like the most urgent thing in the room. Your early retirement plan does. You try to maintain eye contact with the senior VP, nodding at a slide titled Strategic Synergy, but your heart is currently experiencing the kind of volatility usually reserved for a penny stock in a hurricane. Welcome to the modern professional's paradox, trying to climb the corporate ladder while simultaneously praying a decentralized protocol doesn't pull it out from under you. Today, we're dissecting the intersection of political branding and digital assets, specifically focusing on the recent tremors surrounding Donald Trump's crypto ventures.
Seriously, moving on to our first segment, the launch that whispered. In the last 24 hours, the crypto world has been fixated on the performance of World Liberty Financial, the Trump-backed decentralized finance platform. Despite the massive media buildup, initial token sales for WLFI have been described by analysts as significantly underperforming expectations. Out of a goal to raise $300 million, the project only managed to move a fraction of that in its opening window. The primary bottleneck? A combination of technical glitches on the website and a complex whitelist process that seems to have deterred even the most loyal supporters. It turns out that even in the attention economy, friction in the user interface is a greater deterrent than political controversy.
Urgent. Turning our attention to the regulatory shadow. Reports from the SEC today suggest that the agency is not softening its stance on non-transferable tokens, a category the WLFI token currently occupies. This technicality is crucial for the global professional to understand. If you can't sell the token on a secondary market, it isn't an investment, it's a digital souvenir. The leak that caused recent market jitters suggests that the project's governance structure may face intense scrutiny under the Howey test, the decades-old standard for determining what constitutes a security. For those holding Bitcoin or Ethereum, the fear is contagion, that a high-profile failure in the Trump sphere could trigger a broader regulatory crackdown.
In other news, the broader market is reacting to what is being called the Trump-Harris crypto arms race. For the first time in history, digital assets have become a core campaign pillar. Recent data from the Federal Election Commission indicates that crypto-linked super PACs have raised over $100 million to influence key races. This has led to a fascinating decoupling. While the Trump leak caused a localized dip in DeFi tokens, Bitcoin remains resilient, trading near the $67,000 mark as of this morning. Institutional investors are no longer viewing crypto as a niche hobby, but as a geopolitical hedge, a term we're hearing more frequently in the halls of global investment firms.
Urgent, moving to a more concerning development, the social media breach. Within the last 48 hours, security analysts have flagged a rise in sophisticated phishing attacks mimicking official World Liberty Financial communications. Seriously, this follows the high-profile hack of the social media accounts belonging to members of the Trump family earlier this year, which were used to promote fraudulent token addresses. Thoughtfully, for the urban professional, this highlights the security tax of the crypto age. Your 2FA is no longer a suggestion, it's a survival requirement. The leak of a new project often serves as a siren song for scammers who capitalize on the FOMO of busy executives who only have seconds to scan a headline between meetings.
Turning to the technical analysis of the leak itself, independent blockchain audits released today suggest that the code for World Liberty Financial is largely a fork of Aave, a well-established DeFi protocol. While forking code is common in the open-source world, the analysis reveals that the Trump project includes a 20% founders set-aside of the governance tokens. In the world of decentralized finance, this is seen as highly centralized. The leak regarding this allocation has caused a rift in the DeFi community, with purists arguing that it violates the spirit of decentralization, while pragmatists suggest it's simply the price of bringing crypto to the mainstream.
In a related story, the whale movements have reached a fever pitch. On-chain data from the last 24 hours shows that several dormant wallets, some dating back to the 2017 era, have moved significant amounts of Ethereum into liquid staking protocols. Analysts suggest this is a flight to quality, as the hype around politically affiliated meme coins or celebrity-backed platforms fluctuates based on the latest news cycle. The smart money is moving back to the infrastructure layer. The lesson for the educated professional is clear. When the headlines get loud, look at the plumbing. If the underlying protocol is solid, the noise is just that, noise.
Turning our focus to the global impact of the U.S. election on crypto volatility, international markets, particularly in Hong Kong and Singapore, are reporting increased hedging activity. Traders are using prediction markets like Polymarket to bet on the election outcome as a proxy for the crypto market's future. Currently, the odds for a pro-crypto administration are fluctuating wildly, leading to what some call the Polymarket premium. This is a new form of market intelligence where the wisdom of the crowd is being used to price in political risk in real time, often moving faster than traditional news outlets. In other business news, the intersection of AI and crypto is the new frontier. Several startups have recently secured funding to build AI-driven trade bots that specifically monitor political sentiment on X, formerly Twitter, to execute trades. The Trump crypto leak served as a stress test for these systems. Early reports suggest that algorithms were able to identify the sentiment shift in milliseconds, long before the Apple Watch on your wrist could even vibrate. This puts the human professional at a significant disadvantage, reinforcing the idea that for the average investor, time in the market beats timing the market.
As we wrap up this news cycle, let's look at the macro picture. The Federal Reserve's latest comments on interest rates continued to be the primary driver for all risk assets, including crypto. While a leak about a specific token might cause a 5% swing in an afternoon, the long-term trajectory of your portfolio is still tethered to the cost of capital. The professional who stays calm during the quarterly review, ignores the buzz on their wrist, and sticks to a disciplined rebalancing strategy is the one who ultimately wins. The Trump crypto leak is a fascinating case study in how fame, politics, and technology collide. But it is also a reminder that in the digital age, information is both our greatest asset and our most dangerous distraction. This has been a deep dive into the headlines shaping your financial future. Stay informed,